Hello, and welcome back to another episode of Fintech Recap. We are going into the busy and exciting month of October, and as such, we did what we always do, which is bring Jason Mikula on to talk about what's been happening in fintech and banking. Jason astutely pointed out that even though a lot of the things that we talked about in this episode felt like they had happened years ago because of how quickly the industry is moving these days, they all in fact happened in September. This includes JPMorgan Chase and Plaid coming to an agreement on open banking and what that means for the larger ecosystem. Jason and I break that all down. It also includes some new reporting from Jason on what's happening with Evolve, Synapse, and Mercury. So we make a flyby over BaaS Island. We also talk about something that really has not come up too much in this particular podcast before, which was what large incumbents are doing with generative AI. FICO had a very interesting product announcement that I spent some time pulling apart, and Jason and I talked about what it means for shareholders, for banks, for lenders, for FICO. Finally, we wrap up by obviously talking about some things we can't let go. Jason had a wonderful rant relating to his experience on a webinar recently about debanking. I talk about a mysterious stablecoin issuer that is raising money at an absolutely outrageous valuation. All of that and a lot more fun on this week's FinTech Recap. So without further ado, here is my conversation with Jason Mikula.
This is Fintech Takes, the podcast keeping you in the loop on all the latest fintech trends, news, and ideas. I'm Alex Johnson, creator of the Fintech Takes newsletter, your host and self-confessed fintech nerd. Let's go.
Okay, Jason Mikula and possibly some dogs are joining us on today's podcast. Jason, how are you?
I am good. I realize I should put a calendar hold on my calendar at 5:30 my time because that is dog dinner time.
Oh,
and they know you have a dog, right?
Yeah. Well, yeah. We had to put him down last year, but yeah, I've had a dog for many years. Yeah.
I'm sorry to hear that, but
That's
did
okay.
he or she know when it was dinner time and come and stare at you?
Yeah. I mean, totally. Yeah. And they'll whine and they'll just it kind of reminds me actually of toddlers where it's like, I've decided to make this your problem. Like it wasn't before, but now it's going to be your problem, and it's going to be your problem until you fix it. And they're very good at doing that. And I will say the other thing about dogs is remarkable internal clock, because it's not like they know what time it is. I remember when I would feed my dog, sun would be up. I don't think he could really tell what time of day it was, but boom, as soon as it was 5 o'clock, he was right there letting me know.
Internal clock. And I also read, I work from home, so this is irrelevant, but my partner does not. I read that the sense of smell is so sensitive that they can actually detect the half-life of your human odor declining over the course of the day to understand when you're supposed to be back.
Wow. No, it wouldn't surprise me. I mean, they are clever, intuitive creatures who are making a little appearance on the podcast for maybe we'll have to do a little video clip. That is fantastic. I mean, we're pro dogs on this podcast, so this is not in any way a problem. Jason, I actually got a chance to see you in person not that long ago. I was going to say a couple of weeks in a row, but we actually didn't get a chance to see each other in New York.
I did not see you in New York.
We were in the same city, same events.
Ships passing in the night at Finovate, because you had at least one thing on stage, I think, there.
Yep. I had one thing on stage. You had a couple things, and neither of us saw the other person doing their things, which,
was Kia there as well?
No, Kia was not in New York, but Kia, you and I were all together in Utah, the great state of Utah, for the MX Money Experience Summit, as well as you and I went down to the Lone Pro Salt Flats Summit. Jason, it was your first time on the Salt Flats, right?
I did not know what to expect beyond photos I saw, you and other folks post from last year, which I believe last year was the first one, right?
Yeah.
And this was quite the event.
It really was.
Yeah.
It really was. Yeah, there were concerts, there were monster trucks, there was I got into some spirited pickleball matches out on the salt flats, which just, for any of our pickleball players out there, the ball loses a little zip coming off the salt. I will say that. So that took a little adjusting to, but my team ended up being victorious, which I was happy about. So no, it's been busy, and you get a little bit of a break, right? But then you're making your way back out to the States, if I'm not mistaken.
Yes, it's at least it's about a month from now when we're recording until Vegas, our favorite city.
Favorite city, favorite time, favorite event. Here we go.
So I'll be out for Money 2020 at the late October.
Yeah.
Which I am looking forward to, seeing everybody.
Yeah. It's great, except for the Vegas and the nervous system collapsing and the smoke being blown in your face. Apart from those things, it's really awesome.
Yes, absolutely. But there's been plenty of stuff happening. As I was making notes for this, I'm like, oh, it feels like this happened, I don't know, 3 months ago, but actually it was 3 weeks ago. So should we, do you want to kick us off?
I will kick us off. I will kick us off with a topic that you and I and many others have been covering exhaustively. So we won't spend maybe a ton of time on it, but we should talk about the fact that Plaid defected, I guess would be the way to describe it. I keep kind of coming back to game theory and prisoner's dilemma to describe what's happening in open banking. But as listeners probably know, Plaid has come to an agreement to pay JPMorgan Chase for access to its open banking APIs. The sound you hear is Chase going we told you so. We told you this was a good idea. And apparently it was. As I understand it, the structure of the pricing remains the same. So payments use cases are still more expensive, and you can draw whatever inferences you want around that into Chase's view on pay by bank and what they're trying to accomplish from a competitive perspective. But as I understand it, the pricing is lower than what was initially proposed to Plaid, which is good because, as I understand it, the pricing that was initially proposed would have been sort of incompatible with running a business. Plaid is planning, at least in the short term, to eat the costs that they are going to be paying rather than to pass that along. So they are eating into their margin. Now, it's important to note that Plaid has the best margin, I think, of any data aggregator, both based on the volume of transactions that they process, which means they get the best sort of bulk pricing based on the amount of volume they have, as well as the fact that Plaid is generally considered to be, I think, the premium provider in the space. And so they just charge higher prices and thus have a higher margin that they can eat into. The deal also includes, according to Bloomberg, some technical improvements to the APIs, which will improve performance for fintech companies and reduce the strain on JPMorgan Chase's systems. If you've been following along at all of Chase's public commentary really makes it feel as if their computer systems are about to collapse due to Kia Hazlitt constantly pinging their system to get updates for YNAB. So that's going to be easier.
If you hear me laughing in the background, it's like, on the one hand, JPMorgan Chase likes to brag that it invests $12 billion a year in tech R&D, but ooh, too many API calls. Sorry, continue.
No. Yeah, I mean, it's the bank is about to fail based on the number of API hits that are happening. So we're going to improve that, which is great. And Jason, I have a series of questions for you that I'm going to put to you. But the first one, the most sort of elemental one, is why did Plaid do this?
Yeah, I mean, I think your prisoner's dilemma framework is a good mental model for this. I consciously did not copy that when I wrote about it because I'm Alex already did a very good job of using this, and I don't have the time or energy to try to make my own version of it. But yeah, it's I think the way that you phrased it, either in your most recent newsletter or at some point in the past, was we've had this kind of uneasy détente within the sort of brokered within the auspices of FDX, even though sort of FDX's mission, as I understand it, ostensibly is more narrowly construed around technical API specifications, but it seems like it sort of served as a forum for interfacing between, these different aggregators, fintechs. I don't even like framing it this way because it's like lazy and like wrong, but whatever.
Yeah.
Fintechs who are data consumers and data providers, I guess would be a better way to phrase it.
Right. Data consumers mostly being fintechs and data providers mostly being banks, but yeah.
And, JPMorgan Chase, in the wake of the CFPB announcement, or I guess filing in the BPI case that it was asking the court to vacate the rule, JPMorgan Chase basically threw a grenade onto that situation. In the scramble to sort of figure out everyone's next best move, Plaid, as you pointed out, is kind of the heavyweight in that data aggregator space. If you try to think through what was the array of options, there was, as we both I think understand, a lawsuit that was brewing that I believe it was it F Data?
It was F
intending
Data.
to file, intending to file against Chase. You still had like this new open rulemaking that conceptually, could still be influenced, although I think the writing was kind of on the wall that like whatever happened in this CFPB rulemaking process, it felt like fees were going to be part of it. Now, whether that was specifically prescribing some sort of fee regime or just being silent on the question, aka permitting fees, like it felt like there was no possible way the outcome was going to be the same as it was before, which was prohibiting fees. And so if you're a Plaid, it's like, well, if we have sort of the most market power on this data aggregator side, like, do we want to sort of link arms with our, frenemies, right? MX is a competitor. I guess in some sense, Yodlee is a competitor, et cetera. Or do we want to, as I put it in my newsletter, throw them under the bus and, strike a deal that we think is in our own best interest, given how we believe this is likely to unfold? I think you pointed out that Plaid presumably wants to IPO at some point. And as part of a strategy to mitigate risk, coming to an agreement with JPMC, at least for the moment, puts this fee question, at least in the very short term, puts the fee question somewhat to rest. But then it opens up, to continue the metaphor, it opens up the next round of game theory, which is, well, what are all these other banks going to do? What's PNC going to do? What's US Bank going to do? And I have a hard time believing that Plaid is just going to eat these costs indefinitely. I certainly don't know. I have no idea what the terms of Plaid's commercial agreements with its data consumers are. It's entirely possible that they couldn't pass along those fees immediately, but those contracts will come up for renewal or renegotiation eventually. And I struggle to believe that Plaid, Plaid's executive team is just like, oh, sure, like we're going to eat these fees from Chase and potentially from other banks, if and when other banks have the opportunity to renegotiate their bilateral data sharing agreements with Plaid. So that is my only partially informed game theory read on it.
Well, I think that's right. To build on your point about the other banks, this is definitely going to kick off a set of things, right, that are going to happen after this. Like, this is the big domino to fall because, Plaid is the Chase of the data aggregator world, right? Would be the simplest way to describe it. Like, they're the biggest ones. They have the most negotiating leverage. They, probably spend the most on lobbyists. Like, they are the 800-pound gorilla in that space. And so the fact that they came to an agreement with Chase, like, a bunch of other dominoes are going to get tipped over. It seems almost assured. And, my guess, and who really knows exactly, but my guess is that there will be a set of these agreements following very closely with other aggregators and Chase, right? Because Chase has the same contractual ability to charge pricing. They gave pricing to everybody in the space. And so even though Plaid is the first one to make an agreement, and I don't know that the other aggregators would have necessarily felt comfortable going first. In some senses, this is better for the aggregators because at least they could kind of follow in Plaid's wake a little bit and hope that like they benefit from the fact that Plaid hopefully negotiated very hard on this agreement. But I would be shocked if Finicity, doesn't agree to something with Chase, right? MasterCard has a larger set of strategic concerns in playing nicely with Chase that I would imagine would inform that. Yodlee kind of the same way. I would guess that like there's probably larger commercial concerns. Yodlee, because they're kind of the oldest one, for any banks that actually use data aggregators, Yodlee owns a lot of that market. And so I would imagine that they probably will come to terms as well. MX is a little bit of an unknown. They're kind of in the middle, but I kind of think this might force their hand a little bit. And so I wouldn't be surprised if they came to an agreement. The tricky ones to figure out are the ones that are more kind of solely oriented around pay by bank, because as I mentioned before, payments use cases are going to be more expensive. It does kind of wreck the unit economics of pay by bank, right? Not entirely relative to debit cards, but like, if you were selling pay by bank mostly based on look how much cheaper it is, and open banking solves all of the like kind of user experience parts of typing in your routing number and account number, like if that was the primary pitch you were making, which for the most part has been the case in pay by bank, this Chase deal really does kind of screw up that pitch. And so you have a company like Trustly. Trustly on the one hand, I don't think they have enough leverage to really push for something different than what Plaid got. But because their business is so oriented around, pay by bank, it's difficult for them to accept as well. And I think the other thing that bears mentioning here is, JPMorgan Chase was not going to turn off access for Plaid, right? Like they were going to negotiate with Plaid as long as it took to get to something that they could both be happy with. Because as much as Chase likes to talk tough about this stuff, can you imagine like everyone's connections through Plaid for Chase turning off and Plaid controlling the interface that could explain to consumers exactly why that was happening? Like that was going to create a huge, Chase was going to get a lot of customer service calls. We'll put it that way. And, maybe some calls would have gone to, congressmen or to like whatever's left of the CFPB. Like it would have been a problem.
That's exactly what I was thinking. It very different industry, and I don't know. Is Uber a thing in Bozeman?
We have a couple.
This was like a very common thing that Uber would do in municipalities that were either proposing local ordinances or otherwise cracking down on Uber. Like they would send emails, they would send push alerts that are like, call your. Chicago has aldermen, so I don't know what they have in Bozeman, but like call your alderman, call your city councilman, and like complain. Totally. And you could see, something like that happening, here.
Or push this button and a post will tag President Trump on Truth Social. You could do whatever you wanted to like make it a problem. So I just don't think that Chase was willing to walk that far. But the reason I mentioned that is. Trustly doesn't have that same leverage with Chase. And if Trustly was like, we'll stir up a huge problem for you with consumers and with Congress, I don't know that Chase is going to take that threat seriously. And so, Trustly has a lot less leverage. The most interesting one to me is Stripe, because Stripe has leverage because they're Stripe and they have great lobbyists. They have great policy people. They can make a fuss on Congress. They can make a fuss at the White House. They're tied into the crypto ecosystem in a way that would allow them to probably get right to the levers of power immediately if they wanted to. And the most important thing to know about Stripe is they do some form of data aggregation. In my understanding is they wrap other data aggregators for like long tail access, but then they do work directly with the Chases of the world to use their APIs. Primarily for pay by bank. That's the main thing that they use data aggregation for. And the pay by bank part of their business is big, but not like existentially big. So it's kind of this like weird middle ground where it's like, I think they would very strongly prefer pay by bank kind of keep its current unit economics. But I also don't think that they are betting the entire company on pay by bank. Like that's more of a stablecoin crypto sort of thing these days. And so I also don't know if it's the hill that they want to die on. But the other thing that's interesting is they were the only sort of company in this space to submit a comment already to the CFPB. And I wrote about this in my newsletter, but my understanding of the purpose of Stripe's comment was basically to get the CFPB to try to stop any banks or data aggregators from coming to an agreement like Plaid just came with Chase. Like they wanted basically to freeze the market as it is right now while the rule was still being kind of worked out where no fees were going to be put in. Plaid just kind of knocked that strategy over. And so I'll be curious to see if Stripe decides this is a hill we want to die on. We want to try to make this a big deal. We don't want to sign a deal with Chase, or if they kind of look at this as, the writing's on the wall, we can live to fight another day in other areas, and we'll just kind of see what we can get out of a deal with Chase.
No, I mean, I think you used the phrase, the facts on the ground have changed, right? So it's like, okay, technically, the existing 1033 rule remains the regulation, although the compliance date, the earliest compliance date is sometime next year.
There's kind of an argument in like nerd lawyer circles on like, does the rule without the compliance deadlines having hit prohibit fees? Does it not? Like that's a bit of a point of debate, but like arguably it does, or at least it will in 2026.
But, as we've discussed before, the only rule is there are no rules. And so
that's right.
If the facts on the ground are, Plaid and JPMC have come to this agreement, like I find it hard to believe that that's not at least indirectly going to influence how whoever the three people left at the CFPB are thinking about the new rulemaking process, which the global consensus is no matter what is in this new rule, there's going to be a court challenge. There's going to be a legal challenge from whoever is not happy or from everybody.
Yeah, no, we're going to be stuck in legal hell forever. I wrote about this too, where it's like the CFPB is so screwed on this, and there's just no way out. I've talked to a bunch of people, and it's like, yeah, you could keep the prohibition on fees in the rule if you wanted to. The banks wouldn't be happy. BPI will sue as soon as that is the case. So that's not going to work, really. You could, just as you said earlier, decide to just take the prohibition on fees out and just leave it completely neutral and let the market work itself out, which is probably the most likely case, given that the facts on the ground have changed and aggregators and banks are doing that. But guess what? That F-Data lawsuit against Chase, like they can repurpose that and put that against the CFPB if they don't like the rule. Like the rest of the data aggregator and fintech community is not on board with the idea that the private market should just figure out the fee question, even though Plaid and Chase have done this. Or you could try to do the Durbin Amendment thing and set a specific price as a cap based on a calculation of the costs that it takes to stand up and support these APIs. That's a little challenging, though, because the cost for Sky Federal Credit Union in Bozeman, Montana versus JPMorgan Chase, like, how do you parse out the differences between those? Like, it's enormously complex. And if the CFPB tried to do that, they would get sued by everybody immediately and forever. And so there's just no real good way out. And I think, in keeping with the year of our Lord 2025 and how the economy and politics and all other things work, it's just going to be the strongest sort of setting the rules for everyone else. That sort of seems to be directionally where we're going. Jason, let me ask you one more question on this, and then we'll jump to your next topic. Was Chase right to do all of this? Did their strategy work? Is it like, I gave them a hard time in the newsletter and in previous podcasts going like, Chase overplayed their hand. They made a huge mistake. This was a strategic blunder. And yet, here we are. They have a deal with Plaid. They're probably going to have deals with other aggregators. Did it work?
Honestly, it looks like it worked. Right? I mean, it had. If we try to think about the counterfactual, had Plaid linked arms, with whoever its potential frenemy allies are, and push back, F-Data files a lawsuit, the aggregators rally the troops to unleash a torrent of comment letters on the CFPB. Might this have turned out differently?
Yeah.
It's impossible to know. So possibly. But if Chase's goal, which I think you and I both tend to believe was, if not kill pay by bank, at least
hobble it.
Wound it, hobble it, make the economics less competitive to cards.
Yeah.
As you were talking about pay by bank earlier and Trustly, it's like, also to make that work, you need to provide some economic incentive for users to want to adopt it.
Correct.
So if you have that expense and you're increasing the cost of the transaction, it continues to become less competitive to cards, and particularly credit cards, right? Which is what JPMC wants people to be paying with.
Yeah.
So I mean, if the framework is, Chase wanted to hobble pay by bank and change the facts on the ground so that fees are permissible, then yeah, I kind of think they did win.
Yeah, no, I agree. I still will maintain that they probably created more leverage for Plaid than they had to by doing the thing they did and the way they did it and the timing they did it. Like, if they had just waited and the CFPB had just thrown out the rule, I think Chase would have had even more leverage and an ability to do this quietly. And the fact that they did it at the time they did it, and it kind of blew up and became a big thing, and they maybe underestimated how powerful tech companies and crypto companies are with this administration. I do think they misplayed the hand a bit and probably could have done even better. But I agree with you. Like, this ended up where they wanted it to end up. And, Chase is Chase for a reason. This is like what they do.
I mean, I do think, the last comment on this one, I do think that's a very interesting fault line, which, to your point, it doesn't seem like Chase anticipated, which was the Winklevoss factor, or the crypto factor.
Yes.
Because it's like, oh, well, like Coinbase and crypto exchanges also like the ability to use services like Plaid for account funding.
Totally.
But we can leave it there for today. I'm sure we'll have more open banking drama next month.
Oh, gosh. Yeah, no, it'll, I'm sure right now as we're talking, some lawsuit is happening or someone's about to tweet something. All right, Jason, I guess we're going to do a flyby BaaS Island. What are we doing here? Is that what we're doing? Is it's like flyby, right?
Yes, I'm going to try to keep it quick. Honestly, I thought, I didn't even realize that this story had happened since the last time you and I podcasted.
I know.
I feel like I have to include it, even though, frankly, I would rather talk about other things.
Yep, go fast. You got it.
But yes. So the TLDR is the FBI is probing Evolve and its sprawling network of fintech programs. This isn't entirely new information, right? So as I was the first to report back in January, we knew that the Southern District of New York had convened a grand jury and had subpoenaed a former mid-level Synapse employee. We knew this because that employee had tapped the company's D&O, directors and officers insurance, which that policy seems to have asked him to basically ask the bankruptcy court to make sure that any payments coming from the insurance were not interfered with in the bankruptcy proceeding. So that, normally that stuff would not be public. The new piece of information is I spoke to about a dozen sources who have been in direct contact with the FBI and other law enforcement. The folks from across the spectrum of the story. I'm not going to say more about who, given that it's an ongoing investigation, and these folks understandably do not want or cannot be publicly identified. What the FBI seems to be investigating isn't too surprising. Basically, it boils down to who knew what when it comes to this shortfall in funds.
Yeah.
Based on some of the questions people said they were asked, it seems likely that the FBI has a copy of Synapse's Google Workspace instance, right? So that's emails, calendar entries, Google Drive. That makes sense, right? That the Google Workspace instance is in the control of the Synapse estate, which means in the control of the Chapter 11 trustee, former FDIC Chair Yelena McWilliams, who, as I understand it, has a legal obligation as the trustee to make a referral to law enforcement if she uncovers potential criminal activity in the scope of that bankruptcy proceeding and her work and what she comes across and her team comes across. So, I think one of the pieces I found noteworthy is that the scope of the investigation seems to extend to Synapse's board, which again, like makes sense, right? Like they are officers of the company, which until late 2023 included Andreessen Horowitz general partner Angela Strange. It's worth noting, Andreessen Horowitz is also a major investor in Mercury, a former Synapse and Evolve partner, which arguably helped precipitate the collapse of Synapse. Don't need to go into that right now. And at numerous other fintechs and crypto firms backed by Andreessen worked with Synapse and Evolve at various points in time. The one piece of entirely new information that came from these conversations is it does appear there is a sort of separate line of inquiry around Synapse and Evolve facilitating transnational money movement. So sources indicated that law enforcement was specifically interested in about 10 programs that were facilitating international money movement, particularly with destinations in like Southeast Asia, which is a known nexus for like pig butchering scams. Which, again, Evolve is known to be linked to at least one $15 million pig butchering scheme that leveraged platforms like Wise, like Airwallex, like Mercury, plus the whole separate, insane, solid, easy bank fiasco where basically, there's so many side quests that even I forget some of them. But basically, that one was what appears to be like an entirely allegedly criminal enterprise that was like running what looked like a BaaS scheme through Solid, through Evolve. And there's like a whole cluster of lawsuits related to stolen or missing money there as well. So again, like this is new information, but based on like my laborious, extensive reporting, kind of makes sense. I don't think we need to spend too much time discussing this, but to quote, I think I'm quoting Kia, our friend and now your coworker, generally correctly, like bankers almost never go to jail. Do we think anything is going to be different this time? Should it be different? And like where does responsibility lie? And that is a very loaded question that I'm just going to hand off to you.
Just hand the grenade to me. No, I think it's a great question. I generally think one of the things that's really interesting about this space is, and this has been the subject of much debate amongst all of our bank and fintech nerd friends over the last, I don't know, Jason, it feels like 100 years that we've been talking about this. But, it's interesting because from a regulatory perspective, from a compliance perspective, I have always felt like it's a little, like I understand why, but it's always been a little strange that like 100% of the responsibility falls on the bank, right? Like this is all happening on the bank. It's all happening through their charter. They are 100% responsible. And I get that. I understand why. I know that, the regulators that regulate banks, like that's the choke point through which we exert control and make sure that these things are happening.
Don't say choke point.
Oh gosh, I know. I'm sorry. Jason just got off of a debanking webinar, so I triggered him with that word. I think that like from a regulatory perspective, it makes sense, but it always has kind of bothered me a little bit just from a first principles perspective, because as this story has illustrated very, very well, it takes two or more to tango. And there, I think, is like liability or responsibility that falls across a number of different players in this space. And to go back to the kind of original sin at the bottom of all of this, there's a shortfall in funds. And we still don't know why there's a shortfall in funds. We don't know where that came from or how that happened. But like, it's not outside the realm of possibility. We've talked ad nauseum about the different ways that could have happened. There are somewhat like kind of explainable ways that could have happened. There are somewhat nefarious ways that could have happened. But like from a law enforcement perspective, setting aside the regulatory compliance questions about record keeping and stuff, I just really want to know what happened to all of that money. And I would very much like to know, like, based on who knew what when, and who should be held criminally responsible. Is someone going to go to jail? I tend to agree with Kia that like that's very, very rare, and probably this time won't be any different. But I am very happy that the FBI is at least, I mean, this is what they do for a living. Like, if anyone can find out who knew what when and what might have actually happened that caused this original problem, I feel at least mildly optimistic that we might get more answers than we've had eventually. And so that, I think, is good. I also do find it interesting, just as a side note, that Evolve is like the ultimate bank if you're the FBI and you just want to find out what bad shit has been happening over the last 10 years. Like, they're just the nexus for like, ooh, look over here. Oh, that's interesting. Like, so it doesn't surprise me to find out that, they're looking into transnational money movement and all these things. Like, Evolve is the corridor where bad, irresponsible stuff has been happening for years now. And so I'm sure the FBI is eagerly taking advantage of all the different ways they can try to trace bad things that have kind of been funneled through that bank over the years.
I mean, I'll make one last comment. We can get on to something new and more interesting. But I'm not any kind of lawyer. I'm certainly not a criminal defense attorney or a prosecutor.
Yeah.
So this starts to get well outside my wheelhouse. But in sort of researching that, when I wrote this up for the newsletter, the point that somebody made to me, a former prosecutor, was that, if SDNY wants to make a case, all they really need is a single charge of wire fraud. And like, that is enough to potentially put somebody, in prison for like 20 years.
Sure. Yeah.
So it's like, if you have a fact pattern that can reasonably establish that, you have the potential ability to indict and charge. Clearly, it sounds like, there's a lot of stakeholders in the situation.
Yeah.
There's like a lot of different lines of inquiry. And it's like these kind of white collar crime cases can take years, to investigate.
Totally.
So it unfortunately, it seems like we're going to be stuck on BaaS Island for a while longer.
Oh my goodness. I knew that. I guess I knew that when we coined the term that we'd just be visiting forever. But that was a pretty quick flyby. So
yes.
I appreciate the update. Can I give you something new?
Please give me something new.
All right. So this is a story that you actually sent to me, and you're like, "Hey, what is this?" And so I've been trying to investigate and figure it out. FICO, which is full disclosure, my former employer, has released a new product called a foundation model for financial services. So we're going to talk a little bit about AI here. This model is apparently made up of two different things. One is called a focused language model for financial services, and the other thing is called a focused sequence model for financial services. Okay, what are those things? What does that mean? What is all of this? And I think it's worth going into the story, as Jason, I think you were, with a level of skepticism, because everyone just says AI things right now, and the market is, I think, mispricing basically anyone who says anything even reasonably credible sounding about AI, and giving them sort of a premium on whatever thing they can price at that moment. So it's worth sort of trying, I think, to separate hype from reality. So what are we talking about here? To give you a little bit of background into the wonderful world of large language models, the essential choice that you have to make when you're using this underlying transformer architecture to sort of evaluate data and build models is how much data you want to use in training your models. So the underlying architecture itself allows you to identify patterns in large unstructured data sets, which is very useful for identifying lots of things that you can't do with machine learning. That's fundamentally the insight and the power that sits at the very bottom of these large language models. However, the degree of usefulness depends on how much data you use to train the model. So, Jason, you have used many of the OpenAI, Google, Anthropic models, and those are trained on massive data sets, meaning like billions and billions, tens of billions of parameters. Ridiculously expensive and time-consuming to train, like billions of dollars, expensive to operate. The inference is really expensive. They're slow. They hallucinate frequently and behave in ways that are difficult to predict or explain. However, the benefit is, as we've sort of been experimenting with over the last couple of years, they're very smart and very sort of broadly, generally capable. You can ask it to summarize, 1033 and then you can ask it to, re-summarize it in the voice of Dolly Parton, right? Like they're just very broadly capable, and they can do lots of different things. Which, by the way, if no one's asked ChatGPT to summarize financial services regulations in the voice of Dolly Parton, you should, because it's really fun. However, there's another model for doing this, which is to train your model on fewer parameters. So train it on less data. And you can adjust the trade-offs that I just discussed if you do that. So if you train your model on less data, but using the same kind of underlying architecture, it can be faster and less expensive to build, which is great. It can be cheaper and faster to use, also great. It's much less likely, although not unlikely, but less likely to screw up or make mistakes or hallucinate. However, in a generic, broad sense, they are dumber and less capable. They can't do as many things, so they're more focused. And there are actually lots of examples in financial services already of companies basically building smaller, more domain-specific models. So Bloomberg a while ago built Bloomberg GPT. That is obviously specific to finance and the data that Bloomberg has. It's still pretty large, like 50 billion parameters. So it's bigger than what you'd call like a small language model, but it's an example of more of a domain-specific one. A better parallel in this area is Stripe, which built a model that was trained just on payments data. And that was interesting because we don't know exactly how small it was, but we can infer it's probably even smaller than the Bloomberg model. But according to Stripe, it still adds a lot of value and is useful on top of their existing analytic models because payments data has its own syntax, its own structure. It's kind of like its own language. And it turns out that anything that has sort of a structure and a syntax to it, this underlying sort of attention mechanism that's kind of the root superpower behind all these models, that works well for payments data and can find patterns that traditional machine learning can't find. So, bringing it all back to FICO, it appears from my perspective that FICO is following Stripe's lead here, building a much, much smaller model that's much less expensive, about 1,000x less expensive to build compared to like a ChatGPT type model. And that is domain and task specific. So the approach adds value on top of FICO's traditional tools while also getting more performance and reliability for those specific financial services tasks than you would get if you used ChatGPT. FICO in its press release at least talked about several different examples: payments fraud, real-time risk assessment, next best action decisioning. And honestly, I have to say, even though I'm generally skeptical when I see these kind of AI releases, I actually think this is both prudent and relatively sophisticated for FICO to do. I think this is a smart approach for them because they're not just leaping into the deep end in large language models and saying, hey, we're integrating with Anthropic, because I don't think that would really be smart or overly differentiated. And it certainly wouldn't be that profitable. By contrast, FICO has a lot of proprietary data that they could use to train models in those specific areas, right? They have credit risk data, which they use already to train the FICO score. They have fraud data from their Falcon product that they use for transactional fraud that they can use to train fraud models. They have customer portfolio behavior data because they have this product called Triad that is used for a lot of customer and account management stuff across the industry. So they have large proprietary data sets that they could use to train smaller versions of these models. Now, FICO talks in their release about, oh my gosh, by doing this, we've really dramatically reduced the odds that these models are going to hallucinate. They're more reliable. You can trust them more. I still think it's worth being very skeptical about that. The trade-off when you're using transformer architecture and this sort of like attention mechanism is these things still will hallucinate. They still will act in ways that are like, difficult to predict, difficult to explain. I still don't think you would want to like use even a small language model in sort of an automated agentic way where you're just handing over decisions to it. But even if you don't do that, and there's no indication necessarily that FICO is pushing for that, even if you don't do that, I think they still add a layer of predictive value on top of classic machine learning. So to me, this is FICO kind of splitting the baby a bit and finding a path forward with large language models and with this new technology that is consistent with their value prop and isn't like bringing on too much additional risk. So, Jason, I know that was a lot. Does that answer your question, first of all? And then second of all, what do you think about this?
I mean, it answers my question to the extent I understood, 50% of what you just said. I mean, there's, as is the case with so much of the stuff we talk about, there is the hype, PR, comms, positioning, and then there's the reality, right? And I suspect, as it sort of consistent with what it sounds like, how you sort of describe this, that the reality is somewhere in between.
Yes, I agree.
I mean, you can only imagine the kinds of calls, questions, internal meetings where people at FICO are saying, "But what's our AI strategy?"
I know for a fact that's been a conversation internally. Yes. Yeah, no, totally. And one, like, you get asked about it on earnings calls. Like, it's a question that's going to come up, especially for FICO, the king of analytics and financial services, right?
And so, in a sense, regardless of whether, can't believe I'm actually saying this, but regardless of whether or not this actually does what they say it does, or provides, maybe a better way to say that is, regardless of whether or not this provides a measurable improvement over traditional machine learning or linear regression or whatever, it almost feels like they have to do it from a communications, PR, and investor relations management perspective.
Well, they had a terrible last quarter with all the Bill Pulte FHFA stuff, and so I with you on that. Like, we need to put a win on the board would be a very easy thing to think.
So, I mean, I guess what we'll need to do is see who actually tests out these things and talk to them in 6 months or a year and understand, is anyone using them, and do they actually provide a lift in the predictive capability versus whatever they're testing these these LLM powered things against. I mean, something that you've mentioned in the past is how slow, if you're using out of the box FICO, just how incredibly slow banks, typically as banks, credit unions, are to sort of upgrade to the next iteration of that model.
Yeah.
I mean, when I was in lending businesses, worked in more quote unquote fintech or tech forward lending businesses that tended to develop their own internal models and not rely on off-the-shelf FICO or Vantage models. So it's my impression, and I'm curious if this is consistent or inconsistent with how you think about it or what you've seen, is for lending businesses that are very tech-focused, they're probably already developing their own LLM type capabilities. And for lenders that are more reliant on off-the-shelf models, they're probably not chomping at the bit to adopt whatever FICO's AI-powered thing is. So I guess my question back to you is, who's this for?
It's a great question. I mean, I think going back to your earlier point, it's for the stock market first and foremost. And I think any AI thing right now is we're doing this so we have a nice quarter, and the analysts are happy with us. So I think it's definitely for them first. But I do think you're poking at a good question, which is it's not just fintech companies, right? Big banks all build their own proprietary models, and if you talk to American Express or Capital One or JPMorgan Chase, and you ask their credit risk executives, how reliant are you on the FICO score? They're like, the FICO score, we know how to build the FICO score. Our model's way better than the FICO score. It kicks the crap out of the FICO score. The big sophisticated lenders have for years, for decades, been developing their own models that they believe significantly outperform the FICO score. So you're absolutely right about that. And on the flip side, the very small lenders, the very unsophisticated lenders that still use FICO score cutoffs, they don't know what LLMs are, to be totally candid. And so there is a bit of a Goldilocks problem where it's who are we building this for? I will say that I do think there is an interesting discussion to be had about, with LLMs specifically, what's the right size of data to train these things on for financial services tasks? And it's interesting, right? Because the reason that a proprietary credit risk model from Capital One beats the FICO score is not that the FICO score is bad. It's that the FICO score is a generalized model that is trained on industry data that's meant to work across every portfolio for every lending product. So if Capital One comes in and says, hey, we're going to build a version of a FICO score, but we're going to build it for this specific product, for this specific portfolio based on our customer data and our customer segments, well, of course, that model is going to outperform the FICO score. FICO could build a custom model for Capital One that does those same things that would perform just as well as that. So it's always been kind of unfair to compare institution and portfolio and product specific models to the FICO score, which is generalized. However, with large language models, the question is, what's the right size of data that's going to teach this little large language model the right patterns so that it comes up with the smartest observations on top of the existing models we already have? It's entirely possible, and this would be, I think, the hope for FICO, that it's better to train that on an industry-wide data set than it is to train on just a proprietary data set. And so the question, I think, would be, is someone who's very analytically sophisticated, like a JPMorgan Chase or a Capital One, could they build a small language model for financial services that is better than the model that FICO could build? And that, to me, is where the argument is going to be, because I think it's entirely possible, just based on the breadth of things FICO sees, and not just through credit bureau data, which anyone can get access to for training these things, but FICO has, I'll just pick on fraud. Like Falcon is used, which is their fraud product. It's used to monitor credit and debit card transactions for fraud across the entire industry. Like they see a ton of transactional fraud data for credit and debit cards. They probably have the best view. Stripe might be somewhat competitive, but they probably have the best view in the industry of what patterns actually might lead to transactional fraud. Building a specified sort of small language model just built on that data set, FICO might be the best ones in the industry to do that, which is very different than like traditional credit scores where, Chase and those guys were always going to be able to build a better version of the FICO score for themselves. So that might be where there's a little bit of opportunity. But as you said, we'll need to wait and see how the market actually adopts these things. I will also say, just to close, that FICO has actually really had a hard time getting anyone to adopt anything new that they try, right? And as it relates to the credit score stuff, there's a reason for that, because they sell a lot of that through the credit bureaus, and so there's kind of a weird distribution challenge there. But it's hard for any incumbent company to go to their customers and go, this new thing we have actually is great, and you really should take advantage of it. So we'll have to wait and see if the rubber actually meets the road there. But interesting nonetheless. Jason, before I let you go, should we rant about things we can't let go? You have a good one this week.
Yeah, I was debating as I walked home from the gym today whether I wanted to do the one I'm going to do or a different one. This is top of mind because it was, at least when we're recording this, from yesterday's debanking webinar, which I did participated, put on by Ballard Spar, which I guess is going to be released as a two-part podcast because it was 90 minutes.
I am so excited to listen to it. I didn't get to watch it, but I heard some things, and I'm excited to listen.
I was a little intimidated because I was the only non-lawyer, and it included I think he was former assistant Treasury Secretary Graham Steele.
Oh wow!
Legal Eagle Todd Phillips. So like some very sophisticated, deep thinkers about the space. But it was in like the last 5 or 10 minutes, and one of my assignments in the agenda was to argue about Trump's executive order on debanking, if it was good or bad policy, and I decided to argue the bad policy side. I had literally like reams and reams of notes in front of me, but at this point we were like running so far over time.
Sure.
I basically had about 60 seconds to sort of make my case. And so the piece that I decided to use my 60 seconds to make was, arguing whether or not that debanking executive order is good or bad policy is predicated on the idea that it would be implemented even-handedly and impartially. And even within the text of that executive order, it makes explicit reference to January 6th to conservatism, and trying to refrain from reflecting my own point of view here, like including those references within the executive order itself, in my mind, makes it explicitly partisan and explicitly biased, notwithstanding, the extreme events the United States has been through in the last couple of weeks, and some of the rhetoric from the current administration explicitly targeting, quote unquote, left-leaning groups and literally characterizing them as terrorist organizations. So I think the idea that we can take at face value an executive order, even assuming that it's grounded in defensible law, which other real lawyers on that webinar argued that it is not, but even accepting at face value that it is, to defend it requires a belief that it is going to be implemented fairly, even-handedly, and impartially. And I was basically arguing that there's ample evidence within the text of the EO itself, as well as in sort of like the wider orientation of the current administration, that it's reasonable to believe that that will not be the case. And I think the first response of, I forget who it was to call me a partisan, and for some reason that is like really stuck in my craw, because like I am admittedly like a political news junkie. Sure, I don't self-identify as a partisan. Frankly, at least within the realm of financial services, I think the policies proposed by sort of the power centers in both parties are problematic. Totally. And I would have, disagreements with whether that's like, an Elizabeth Warren Rohit Chopra wing of like the Democratic Party. Well, we were critical for 4 years covering all the stuff the CFPB and others were doing. Like, I don't know how that particular thing makes sense, but I will say, like, to build on your point, and I don't think of you as partisan at all. Am I partisan? No, I don't think so. And I think you do an extraordinary job of not doing it. I probably do less of a good job doing it. But the thing that bothers me about a lot of this stuff is I don't like to have to pretend to be stupid. And I feel this way a lot with stuff as it relates to kind of the politics side of policy, right? Where you're like, hey, let's evaluate this policy and let's look at like, it just from a pure like objective sense, like let's evaluate this. And you're like, okay, we're doing that. It makes sense. Like I could see this, whatever. And then they're like, so this is like a good, credible, neutral policy. And you're like, well, yes, if I thought that the motivations behind it were neutral, if I thought the way it was going to be implemented was fair and neutral, if I thought there was no chance of like corruption or bias or preference sneaking into the way in which it's enforced and legislated, then yes, I would think that. But like, just look around. There's no reason to think that any of those things are true. And I will just say, and we don't have to get deep into this topic, but like debanking kind of rhymes with the free speech stuff that we're talking about right now on a societal level, just in the sense that like, you're either for it on a general sense, which means you're for it for everybody, or you're not. And I do find a lot of the claims and arguments getting bandied about right now where it's like, well, we're for it as long as it's for the things we like, and we're against it if it's the things we don't like. Well, it's like, okay, then you're not for it. Like, I've always really liked the principle approach to regulation and policymaking, which is like, these are the rules. They're going to be true for everyone. And I do need to go and listen to your podcast, but I will say that I am generally a fan of like, let's just strip reputation risk out of it. Let's just let banks kind of make their own determinations about this stuff and like just kind of live with the results of that. To me, that seems very neutral and very fair. But I have 90 minutes of great conversation to listen to before I finalize my take on anything related to debanking. The word debanking doesn't even mean anything at this point, which is actually, I had the very first section, which was the history of debanking. And that was the point I made at the very beginning. Yeah. It's like, this word has become meaningless. Right. But I will stop my partisan rambling and let you go.
Well, mine is not partisan. I don't think it is. I guess everything is these days. But I do continue to find this company interesting. We don't talk about them a lot on the podcast because they're sort of a shadowy cabal that we don't understand well enough to talk about them. But it is in the news. Tether, the stablecoin issuer, is reportedly raising money at a $500 billion valuation. And Jason, why? Why are they doing this? I was under the impression, I was told by crypto people that Tether is already insanely profitable and operates on an incredibly efficient basis with a very small team. If that's true, why do they need the money for? What do they need the money for? How can they possibly be worth $500 billion? That's the same amount of money. That's the same valuation that OpenAI is pursuing at this moment. And look, like, I think AI is way overheated, as we were talking about with the FICO stuff. Like, it's a lot of just hype and nonsense and the market overvaluing things. But there is absolutely no way that OpenAI and Tether are worth the same amount of money. Like, that is just no. And the thing about it is, we really don't know how much Tether should actually be worth because they won't allow themselves to be properly audited, despite being the largest stablecoin issuer in the world and saying to the market, and apparently to all of us who are asking these questions, just trust us. It's all good. Stop worrying. So, Jason, it's very Dr. Strangelove, where it's like, I'm just going to have to learn to stop worrying about the threat of, financial calamity and these things happening and just be cool with it. Like, I'm just going to have to lean into that Dr. Strangelove attitude because none of this makes any sense to me at all.
Well, particularly given that the revenue is yield on the reserve assets, and we're evidently in a declining interest rate environment.
Not so much by choice, but they're forcing us to. Yeah, right.
I mean, nothing about this makes sense. Why are you raising $20 billion if you're wildly profitable? How in the world could you possibly... My back of envelope math, there's, based on Googling, about 173 billion tethers in circulation. If you say the yield is 4%, which maybe is too low, depending on what those reserve assets are, that's about $7 billion in revenue. I mean, what kind of multiple? What kind of multiple do you think this company deserves? Again, given that it has massive interest rate risk exposure.
Well, and it's literally just a narrow bank. Like, it's just holding. Like if you believe them, if you believe what they say, which there's really no reason to believe them, but if you believe what they say, it is like the most brittle, concentrated, interest rate sensitive business model you could possibly have with nothing to build on top of it. Like, I don't get it. And yet, like, when I see crypto people talk about it, they're like, it is a generational arbitrage opportunity to invest in Tether. And, I not to make it partisan again, but like, we don't know who's investing in Tether. We don't know anything. So I am just going to turn off that part of my brain that worries about things. I'm going to bet it all on USDT, and we'll just see how it goes, Jason.
All right. Well, we'll have to check in on that. I don't know, next month, I guess. See where things are.
We will. And things might have changed quite a bit between now and then. As always, a delight. I am looking forward to seeing you in Las Vegas. And until then, thank you, sir.
All right.
Thank you for listening to this episode of Fintech Takes. Stay up to date with emerging companies and the latest fintech trends by subscribing wherever you get your podcasts. And if you love Fintech Takes, please tell a friend.